Well, in 1994, no band or act was more popular than TLC. They'd sold 14 million albums, won Grammys, topped the charts, generated $175 million in revenue, and I think found a way into Marcus's heart as one of his favourite all-time bands. But was it profitable? They're extremely popular as a band, but actually because of the brutal record deal that was done between the band and the producers, the three band members only made $50,000 per annum over the next 12 months, and all three of them declared bankruptcy in 1995. So popular, yes. Profitable, not even close. Now, how many here have heard of the Trans-Siberian Orchestra? These are a heavy metal Christmas arena band. Talk about a niche. But these guys, over their history, have earned almost $800 million in ticket sales by playing concerts for only 7 weeks a year, and have found themselves as one of the top 25 live acts of all time. So not many people have heard of them, but incredibly profitable as a music act and a business for the band members. And that's what we're going to talk about today. We're going to talk about popularity versus profitability in markets, and particularly in small caps. And what we're going to cover are areas like AI, incredibly popular as a theme in the market. Private equity, there's a whole session on that next, incredibly popular asset class in markets. And IPOs, the next big thing, is always popular, but maybe, cyclically not so popular right now. So let's start with private equity. Putting aside our views on how private equity mark their performance and the fees they charge, the structure of their funds does enable them to do some pretty interesting things in how they manage the businesses inside those investment portfolios. They tend to have longer term time horizons and alignment with the outcome, right? They're fully invested in the outcome in this business. As a control shareholder, they have solved a lot of the coordination issues that we have as public market investors between minority shareholders, boards and management. They dictate the terms and they get the outcome they want. Good or bad, they own it all. And finally, a part of the value out of the better private equity firms is this deep operational experience and industry knowledge. They buy a business with a view of how it needs to be run better, how they can change it, how they can do M&A bolt-ons to make the business better for when they eventually sell it. So they're not common attributes of a lot of companies in the public market, but it doesn't mean there are no publicly listed companies that have those attributes. And we call these the quiet compounders. These are 7 companies in the Australian market with a very long-term track record. So we're not just talking about cherry-picking the last few years of performance. We're finding businesses with decades of performance running their businesses like private equity do, with those core long-term philosophies. But the other benefits you get in investing in a publicly listed company, which have become a bit out of favour these days, but you do get the benefit of investing in the growth part of a life cycle, which as small cap investors is really important to us, right? We're not buying mature cigar butt sort of businesses and trying to re-engineer them. These businesses tend to have a conservative approach to leverage. They've been around a long time. They've seen cycles. They know that, as Marcus said, having too much leverage can see you go out the back door if you face a recession or a downturn. There's full transparency. They're listed on the exchange. They provide their accounts. You get to see exactly how the business is running every 6 months. Daily pricing and liquidity, and you pay no control premium to invest in them. So they're not common, but they are available in the market. And it's interesting looking at listed companies through the private equity lens to see what sort of outcome we can generate. Now, these are the names on the left. These are our 7 quiet compounders. And they probably strike people with more nostalgia than they do excitement, right? These are sort of the wallflowers of the market. You look at them and you go, oh, I know that company. I've seen that for years and years. You can see Eagers is on there, the company that Marcus just talked about. But these are the companies who have delivered very strong returns applying this business model to markets over a very long period of time. Now, in the past 5 years, the average of these companies has outperformed the All Ords by 10% per annum. But that's not really what we're interested in today. We're interested in the long-term performance of these companies. And so if we go back over 35 years, and many of these companies, even though some of the names have changed, have been listed on the ASX for a very long period of time. And the average of that group has outperformed the All Ords by almost 7% per annum. So you can find publicly listed, in many cases, X100 companies other than Soul Patts and 7 Group Holdings. The rest of them are all X100 small caps. You can find businesses that can generate these type of long-term returns with that alignment and with that focus on long-term investing. The second theme or thing that sort of waxes and wanes in popularity I want to talk about today are IPOs. So you can see here over the past, or since 1998, we've had about 2,500 IPOs in the Australian market. Most of these happen in the small cap space. One thing that's pretty obvious is that at various points in time, like in 2000 or 2007 or 2021, the market for IPOs is extremely popular, often coinciding with when small caps are in favour, share prices are high, and lots of companies are rushing to the markets. And then there's other times like 2001, 2002, 2008, 2009, and more recently, when it's just not popular at all. No one's interested in listing, no one's interested in investing in IPOs. Now, when we look at the series of those IPOs over a long period of time, many of them are tiny, right? Very small microcap businesses. And only 24% of them are actually investable over $50 million of market cap. So about a quarter of the IPOs would be investable, but we still think you need to pay attention to what you're buying, right? You can't just say IPOs are good or IPOs are bad, let's buy them all or not buy any of them. So we've gone and done some analysis on what the performance of IPOs look like over that 25-year period or more, almost 30-year period. And we call this the IPO berg. So we're only looking at those investable IPOs, and 58% of them end up below their issue price over time. So you need to be selective. You can't just buy an IPO because a broker tells you it's a good or new idea. 42% of them end up above the IPO price, but only 20% of them end up beating the Small Ords index. And that's the goal. Our goal is to beat this passive index, and so we need to be selective in figuring out which of those IPOs we want to participate in and which are going to deliver the returns that we need to outperform that index. And so with the theme of AI, we did ask AI if you sort of look for the intersection between icebergs and investing, what sort of ideas should we think about? That's what I came up with. So what does a good IPO look like? When we're presented with IPOs, we only have the information available in the prospectus, and we can do other work around that to figure out what's going on in the industry or the history of the business. But it's really interesting to us what companies are willing to put in the legal document and what forecast directors are willing to sign off on in terms of the first forecast year. Now, What If is a business that IPO'd in 2006. Booktopia IPO'd in 2020. And so for each of those, T is the last actual year they reported. T+1 is the forecast year. And we're trying to determine, can you tell at the time whether or not an IPO is a good investment or not? Well, if you look at gross margin or commission growth, both What If and Booktopia were growing quickly. What If was growing faster, but both of them were growing north of 20% per annum. But if you go and look at cash flow, you get a very different story. What If was wildly cash flow positive. And in fact, the directors were so conservative that in the forecast year, despite the revenue growth and the margins, they actually forecast the free cash flow would go down. Now, we knew, with the benefit of hindsight, it was actually a lot higher. But at the time, you could see the conservativeness in those numbers. And then Booktopia. The directors wouldn't even sign off on a positive free cash flow number, and the business had never generated really much positive free cash flow to start with. So immediately presented with two very different businesses, and it's not really surprising that 5 years after the What If IPO, that outperformed the Small Ords by 25% per annum. And we haven't even got to the 5-year anniversary of Booktopia, and as many of you will know, that business has now gone broke. So often as investors, the information we have at the time gives us a very good sense of what a good or bad business looks like and whether this IPO investment opportunity is going to be fruitful for us or potentially one of the underwater stocks. So finally, let's do a final head-to-head of profitable versus popular, comparing one of the hottest themes in the market, again, AI, but this is NextDC as a data centre. And I'll show you some numbers on NextDC, but these numbers are pretty similar if you look at any data centre business globally. So the market's excited because of all of the growth in AI usage, all of the growth in data centres, and these dots on the page, that's the EBITDA that NextDC has been generating. So that number's been going, up and to the right. Looks terrific. The problem is these data centres are incredibly capital intensive. So the return on invested capital has been falling almost every year and is now approaching zero. And even as a thought experiment, we have this EBITDA going to about almost $900 million in 4 or 5 years' time. That's almost twice what consensus thinks this business will do. And even at that level of EBITDA, the business barely makes a 6% return on capital. So it's not a great business, even though it's really, really popular. Maybe it's like the TLC of stocks in the market. And then Imdex. Imdex is a mining tools and technology provider. It's been around for a long time. It's clearly cyclical. You can see the return on capital for Imdex over time has been as low as negative and as high as almost 30%. But through the cycle, it earns a 15% return on capital. That's a pretty good number, right? And that's a number that we think will rise over the next few years as the mining cycle turns and the penetration of higher margin products within the Imdex business continues to grow. And so what it ultimately means when you're investing in these businesses is the returns you receive, right? Popular or profitable. And over the last 5 years, Imdex has earned almost 3 times the per annum return as NextDC. So just investing in what's popular is not necessarily the way to outperform markets. You need to understand what's happening in the business and whether it's profitable. Okay, so just finishing off. What's the bigger picture for small caps at the moment? It's been a pretty tough 4 or 5 years. But standing here in mid-2025, we now see small caps at the largest discount to large caps that they've been since the GFC, right? So they are very unpopular at the moment if price to earnings multiples are a measure of market popularity. Interest rates, which have been a really strong headwind for the performance of small caps for the last few years, have clearly rolled over and are becoming a tailwind. And we're seeing that in a lot of the sort of macro data as well. And then finally, IPOs. IPOs are something that tends to correlate with when things are popular or unpopular. And right now, with the very low level of IPOs in small caps, it tells us it remains a really unpopular part of the market. To us, that means opportunity. That means over the next 3 to 5 years, it's very likely to be quite a profitable place to invest when you're buying something that's cheap, you're buying something with tailwinds, and you're buying something that's out of favour. So that's Longwave. We're here to try and deliver more consistent alpha at lower fees. We're trying to focus on those more profitable businesses and resist that popularity. So I think Kyle's now going to give a rendition of Waterfalls. I think that's what we're doing now. Is that right? But thank you for your time.